Welcome everyone to the Estate Master User Group live seminars. This is Series 7 of our series for the user group, and today I'm going to provide you with an introduction to the financial sheet and the preferences. The course will outline the concept of profit and loss versus cash flow, the concept of work in progress, operating expensed costs, and revenue recognition, as well as a fixed asset register in case we want to hold the assets for, say, renting. And then the presentation is around 35 minutes, and then we can have some questions and answers. Each of the attendees have been muted just to make the sound easier for everyone to hear. But if you have any questions, please don't hesitate to use the comment box to contact me. If you had some other colleagues who wanted to join, I do apologise. The actual original invitation had an incorrect address for this meeting, so we have updated everyone with a new address. But just in case you don't see one of your friends there, just maybe forward the email with the new address so they can join us as well. So let me begin now. I'll just run through that PowerPoint, and I'll bring across a model which I have prepared. This feasibility model is, I've got a number of different options in here. I've got option 1 for land subdivision, and we're using the revenue recognition method of on completion. And then I've done another one where we use it on a completed basis, and I'll show some variations that we have on that. And finally, I have an option where we actually develop a building, hold it as an asset for 10 years, and then sell it. So that's another project which I'll show how to do. But I'll start with the first one, and we can go from there. So let's call back in option 1 for me. The very first thing to note is the financial sheet does not appear at the bottom here until we go up to Preferences, go into Financial Reporting, and click Enable Reporting. That's the very first little thing to note. Now that financial sheet appears. Now, the very first important point to make is that cash flow does not equal profit and loss. Well, what I mean by that is that in this particular example, I have a land purchase of $1.5 million. For simplicity, I've only used time periods of annual time periods just to demonstrate this. But essentially, I have a land purchase occurring in the first year, some professional fees which spread over these 3 years, and some construction costs which spread over 3 years, land subdivision costs. And I also have some group overheads, and I have some land holding costs, which is giving me these type of total costs. So the net cash flow before interest is a negative 2.8 million, but because we're doing a staged development, we've got some sales occurring in year 1, 2 and 3, we have some positive cash flow there. When we take into account the amount of money we put in $1 million equity, we come down here and we find we borrowed this amount, we actually find that the cash flow is a significant 2.8 million in the very first year, and then some positive returns, 1,075,000, 1,075,000, and then 2,175 at the end. Briefly, if I go to the financial section, the P&L, here's the items that we discussed before coming through, but in the P&L, we have a different story there. Some costs are expensed, and we show a loss in that particular case of a certain amount. We expense the operating expenses as well as some holding costs. We show a negative 250. So that negative 250 in the P&L is significantly different to the negative 2.8 million. I guess this is the important point for the non-accountants listening in on this webinar, is that the concept of work in progress, it's similar to as if you bought a property, say a rental apartment. Say you paid $1 million and you're going to get an income of $50,000 or $60,000 each year from it. The taxation department doesn't allow you to write off that $1 million as a tax deduction for that year. What they say, no, that is an investment, and against that investment you can claim depreciation and you claim the interest as income against, the rental as income, and if you have some borrowings on that you can claim the interest on that, but you don't claim the capital cost. In a similar way, when you do a property development, the taxation department says that that's a particular asset that you're building and you have to build that, and you can't realise that expense until you make some sales. So essentially it's the concept of the cost of that particular good. A similar case would be if you're a storekeeper and say you bought a computer for $1,000 and you sold it for $1,500. You may have bought many computers, which has cost you, say 10 computers at $1,000, it's $10,000, but you've only made one sale in 1 year. You can only claim the cost of one computer against the sale of 1.5. So you would actually show a profit, even though of $500, even though you still have that stock in trade. So the terminology that we use in land development or property development is the concept of work in progress. So let me just run through. So the very first thing I mentioned is in the preferences we have a section called financial reporting, and we have these, so the first thing is to tick that on. The second thing, the next question is the revenue treatment. I'm going to demonstrate on completion. Essentially that means that you only recognize your revenue when you've either completed the development and therefore you can claim that money, or in the case of a stage subdivision, as and when you complete a stage and collect those particular money. We have another option in here which is on a percentage completed basis, and I'll explain that later on the second example. But on the on completion is probably the typical one which you would use, and then you would go into the next section here, which is the work in progress, expensed or operating, and this is where we identify which particular item are we going to include in our work in progress, or which items we're going to expense or claim as operating. These are all relevant both in the taxation and also in reporting your gross margins. But generally in the development area, your land and acquisition costs would be a work in progress, because land you sell or building you build requires land. That's part of the asset. The professional fees involved, the designing of the building or the designing of the master plan for the subdivision. The construction fees or subdivision fees would be there. The statutory fees, such as the developer charges, would be a work in progress. I've included in one of my miscellaneous headings group overheads. That's, I guess I would describe as head office costs, which you may have many projects happening, and you may choose to charge a certain cost, recoup those costs. That is what you could call an operating cost, and essentially that allows you to claim that as an expense each year, even though you may have not made any sales. We have some other provisions in here for miscellaneous costs. Land holding costs can be expensed, selling costs expensed, pre-sales commissions typically expensed, leasing costs, finance costs, and now interest costs can be expensed, or they can actually be rolled up into the work in progress. Generally, we would have the interest charges where you're doing a land subdivision and you intend to sell and not hold. You would hold them as work in progress. So I'll just click on that because I just update my cash flow. Just go back into the financial reporting. We've done cost treatment, tax treatment. In this new updated version, we have the ability to roll forward tax losses, or alternatively realize those tax benefits at the time of loss. Generally, if it's a standalone project, it's the only project you're doing, you cannot claim a tax loss until you roll forward and make a profit. In other words, you roll forward those losses. If you have multiple projects, you may have one with some losses, you may be able to claim those tax benefits. Again, that's a complex thing which you need to discuss on a project-by-project basis. Again, when is the tax paid? It could be paid annually, and you would nominate the date it's paid. For our purposes, because we've used an annual cash flow, we're just going to leave that as monthly. There's another option whether the shareholder's equity is project capital or is an intercompany loan. If it's an intercompany loan, it's treated as a loan, and if it's shareholder's equity is capital, then it's equity. So essentially, they are the major items that we need to identify in setting up our preferences. So now we'll just go back and have a look at the cash flow and see how in the financial sheet how it separates things out for you. So let's just read this sheet now. So again, this is just coming from the cash flow. We've got the $1.5 million for the land. And again, now what's happened is we can see that the WIP has gone next to that, means it's work in progress. The professional fees are a work in progress. Just looking at it here. And the construction costs are a work in progress. The statutory fees, we have WIP, but we don't seem to have an item in there. The group overheads, on the other hand, if we just go back to the input section here, in our group overheads, we said that we had a $200,000 times 4, so that's over 4 years, appearing in the cash flow there. So if we go back to the financials, you'll see that that's got an operating cost. We've got nothing in miscellaneous. Project contingency, we didn't put an amount in there. And then our land holding costs, this is for holding the estate, we have chosen to expense those costs. So this shows you the total development costs are $2.8 million. And we can see how that 2.8 million, 5.8 million, you've got 2.8 million in the first year, and then another 1.35, and you can see how that cost is cumulative. And then finally we get the 5.8 million with that final overhead cost, group overhead cost occurring there. The selling costs we have expensed, so they're in an expense line. We've got no leasing costs in this example, and we also included in our development the interest cost as a work in progress. So when you add these additional costs, the total project cost now is increased from 5.8 to 6.27. We can also follow in here which costs are being directly expensed. So they were the directly expensed. They were some summation of the land holding costs and our selling costs. So land holding costs, selling cost provides us with the amounts which have been expensed. Our operating costs are our corporate overhead costs here. And then what's going through WIP is the 5.051, which is the combination of the land, the professional fees, the construction costs, which are going through into our work in progress. So we come down here, and on a completion basis, what it does is for the work in progress, so we're going through the WIP, we've got 5 million. So essentially what this does is we can see how what percentage of the profit is realized. I'd made in my assumption, I assumed that we sold, let's come down here, that we sold 10 lots per annum, starting from year 1, going through into year 3. So we've got 10 lots, so essentially it is an even spread of sales. And so 10, 10, 10, so 1/3 in year 1, 1/3 in year 2, and 1/3 in year 3. So what happens there is, of that 5 million, the WIP, we essentially identify 1/3 of that cost, even though we know that the majority of those costs occurred by year 1. We can't recognize all those costs as in one hit. So therefore, what we have down here occurring is that 1/3 of that cost is identified here, and 1/3 of that cost is identified there, and then 1/3 here. Now if I go and change my sales and say that I only sell 5 this year and next year, and then the balance of 20 in that year, you'll see that my financials, even though will change quite significantly. What will happen is my percentage of realization is 16%, 16.6, 16.6, and then 2/3 later. So again, my work in progress, even though my expenditure has not changed in my work in progress, I can only realize that expenditure in this particular ratio here. Let's go back and just fix that up. So again, the model is dynamic. It does change according to how you do your ratios and how you check that on that basis. The expenditure, the items which we're expensing, the land holding costs, as well as the are expensed, as well as the operating costs. So essentially, the land holding costs and the operating costs mean that we can still claim a loss of $250,000. But then in tax-wise, we show profits of $491 for years 1, 2, and 3. So that's how your tax would appear. There wouldn't be, because it's an asset and we're not holding it, there's no depreciation. Now the other thing that the model does too, it also takes into account the balance sheet for you. Now these items here, that's the work in progress. If we ran up here, we can see that that's a work in progress, and as we sell down, some of that work in progress diminishes. So it's an interesting combination. We're building up. We come up here, we're building up our work in progress because we haven't made any sales. So let's just directly going through into WIP. So that's at 2.6, but we can claim we've got 2.6 plus 1.2, but we're claiming back 1.08. So it's a calculation which you have to work through, but essentially that in the balance sheet is doing that sum in the background for you, accumulating, and then obviously as you move that asset and claim up in the P&L, you start reducing in the balance sheet. That cash at bank is an item that actually relates back to the cash flow that we have here. And this actually comes when we look at we had $1 million equity as well as borrowing the balance. There actually is a cash surplus that occurs in that account, and that is then shown in the balance sheet as cash in bank in that year too. This is the drawdown of the loans which is coming out of our cash flow here. And this is the project capital. So essentially what's this saying is we are put in $1 million, so that's why it appears each year. This is a balance sheet. So balance sheet is not that we're making $1 million, it's saying that we have $1 million invested in this project. And it's not until we come to the end of that project and make a profit, which we distribute at the end of that project to the directors or the equity holders. We can change, again, we can actually change that dividend policy, and that actually is in the financing section. We can change that to instead of being paid at the project end, we can make that available when available. And in that particular case, it will appear that we actually have still only not able to pay out the surplus until the end. So that didn't have an impact, and that's because if we go back to the cash flow and see the cumulative cash flow, you can see that we're negative, and they're not positive until we finally get into the final year. So if we had been a positive cash flow, we could have had dividends come out earlier, but that's not the case. And essentially, we can see the shareholders' equity is a little bit different too as well. The shareholders' equity is being diminished by the P&L loss there, but then we make a profit, and therefore that increases, and that's the relationship. The reason why we diminish down here is, remember, we had some expenditure occurring after revenue in there as well. So essentially, it's getting that feeling. The model does the balancing for you, and that's how that works. So let me now show you another one where we go into a different setting, and this is where we select on a percentage completed basis. So if we go into the preference sheet here, into the financial reporting sheet here and go into revenue treatment, I'm now going to change this to percentage completed. That's where we do it. So I'm going to call an option that I've already have prepared. Percentage completed, we'll call from there. Now, you remember in the P&L we had a steady amount of profit being accumulated here. In the percentage completed, it does it a different way, and this is important to identify. Let's just make sure I brought the right one in. Call from there. Now, the percentage completed basis does it slightly different. It not only looks at what percentage you've sold, so the percentage sold is still 1/3, another third, and another third. But what it does recognize, it recognizes that the construction of the development is only 1/3 by the end of year 1, and another 2/3 by the end of year 2, and only completed 100%. So the way this model works is it takes the percentage of the percentage completed times the percentage sold to give you the percentage profit that is realized. Now, I've actually got in there 100%. I'll just take that out. So essentially, the profit realized then is not 33% as before, but it's 33%, and the cumulative development costs incurred is 68%. So we only recognize 22% of the profit, and so on. So it is a combination of what this percentage completed as well as percentage sold. So your cash flow here, or your P&L on that basis, is more skewed towards the end of the project, and we realize it at the end. You can even accentuate that by having some what you call custom thresholds. You may actually have a rule that you won't recognize any revenue. And this may be the case in the UAE, where you can actually collect revenue as part of the collection profile. One of the earlier seminars we worked on, you're collecting it, but you may actually have an internal policy that until you actually complete all your works, you won't show any of that revenue. So if I might change that to 100%, what the model does then is move all the profit to that very final year. So it does have a significant impact. That's quite a harsh rule, but a very conservative rule, and we can recognize our profit. You can see from a tax perspective it's quite advantageous. Remember, cash flow, we're still collecting the money. We still have the cash flow looking like this of negative 2.8, but positive 1 million, positive 1 million, and 2.1 million. So we have quite a significant positive cash flow. But in the financials, we've been able to delay our tax payable by a fair bit. Again, the tax rate at the moment, we haven't put it in, but if the tax rate was 20%, that also would have the impact of the after profit being 979, but we're not paying that tax until the end of the period. So there is this is where the cash flow and tax are different. It's important to understand that. Likewise, in this particular case where we've taken it on percentage completed, made it 100% threshold, and delayed the work in progress recognized, what happens here is we see a different, let's move down to the balance sheet, we see a different thing occurring here. We're seeing the work in progress getting larger and larger and larger, and the deferred income, because even though we've collected that money, remember we've collected the money, we've actually said the P&L we can't recognise it. So that money that we collected in sales is then deferred, so 2.5 million plus 2.5 is 5, deferred until we actually realise that particular income. So the model or the balance sheet comes a little bit more complex, but we're still claiming those operating costs and group overhead costs and interest in dividing and defining that. So again, it takes a little while to type and read that, but essentially they're the key elements. The third element, I guess, to be aware of is where you may develop and hold the asset, and this requires a little bit more manipulation by the user, but again, that is all doable in the model, and just requires a little bit of extra work. So I'm going to give you an example of how that would occur. By the way, you can, don't forget that you've got the help function here, and if you were looking up, the trouble is you've got to know what you're looking for, but if I was looking for fixed assets, actually might actually, it does actually have a case where it says this section allows the user to manually add in and cater for the items that are capitalized as fixed assets, held and not sold on completion. All inputs are exclusive of GST or VAT. So again, you can have a look at this in the help file as well. But essentially, here's a model which I'll recall number 3 now. So let me just run through this particular model in the cash flow. A little bit more complex, but essentially what we're doing here is we've got the $1.5 million in land acquisition. We've got some professional fees as before. This time we've got some building costs. Over a shorter period, we're building a $3 million construction, and we can see there's a total cost of 5.35. But instead of selling the property in year 3, we're choosing to rent it out. We rent it out in the first year at 50%, and then it is a stable rent. And then finally, at the end, we capitalise it at 8% to sell it for $10 million. So that's the cash flow, and that is also, I'll just make that a bit bigger for you, that's reflected in the tenancy schedule. So in the tenancy schedule, I reflected year 1 at half vacancy. So I've got 1,500 square metres, and it's year 3, and it's going for 11 years. And then the next year, I got the more leased, and the other 1,500 square metres leased at $300, going for that period of time. I haven't done any escalations in rents, kept the model simple. I've got some commission on the letting up of the property, and also what I've done is I've actually capitalised it at 9% the end sale value to provide me with, here's the current rental, here's the end sale value, and here's the combined increased rent that I have received from those two particular assets, or those leases, sorry. And so what we have to do in this particular case in the financials is, this is a physical thing, we have to say what will happen is that the model will keep everything in work in progress. So just go down here to work in progress. But if I go up, so they've got $4.8 million in work in progress. But if I go up and add into this line here 4.8, that takes 4.8 million out of the work in progress. We've got asset revaluation reserves which we can play around with as well. But just keeping it simple, there's the 4.8 million. I've done a calculation of depreciation allowance at 2.5% as an annual depreciation allowance. Again, we can write the formulas in here. And then I've also taken back that depreciation expense, which is just the sum, as you can see, the sum of all of that, which is 1.32 million. And I sell it for 10 million because I know that's what I assumed it would be. And in that case, what happens is it then shows that I've made a profit on sale from my cost of 6.5, and that 6.5 then falls into my P&L. So what happens is my P&L is a little bit more complex. With rental income, we don't have to nominate whether that's operating expense. It knows that rental income must be recognised when it's received. So that's the rental income that we're receiving from those two assets. Here we have our landholding costs, and I guess in this case we're assuming the tenant is paying all the landholding costs, so we're only having landholding costs during the development phase. And here is our letting fees, which we're expensing, and here is our interest costs, which we're expensing as we go through. One of the things is you would say possibly those interest costs we can't expense during the development phase, and that they should be taken up in some form of work in progress. We can remove those things through some accrual adjustments here, where we can actually move that particular amount as a deduction out into some later years. But just for the time being, because it's only 2 years, I'm just going to keep it simple. Again, I might just reduce that tax rate so maybe a bit higher there, just change it to 20%. Again, you can change the tax rate month by month, and we can recognise different particular rates. But as you can see here, what happens is we can't claim the cost of the development. We've got the rental income coming in here, but we can't claim that the work in progress we've reduced to nil because we've taken it up in the fixed asset register. So this amount is substantially the interest cost plus some leasing costs that are giving us our costs. And in the first year, because of those additional leasing costs, we show a loss, but from then on in this particular example, we've got a profit that we're showing, and therefore we pay a tax on that particular profit once we've gone to positive here, and that's showing us the after tax. Coming down to the balance sheet, this will make more sense. So here we have the work in progress occurring and accumulating here, and because we've taken it out of the work in progress and put it as a fixed asset, it now becomes a tangible fixed asset, which now on the balance sheet moves to this particular line. So we see the 4.8 million occurring in here, and we also see the cumulative depreciation which we're adjusting for, which we then add back in that particular case. And we can see also the actual interest bill that we're building up and then decreasing. And likewise here, as we can see our shareholders' equity, we had that $1 million in, but we lost 250 in the depreciation. So we're looking a little bit wobbly down here. We start building up our shareholders' equity, and then at the end we pay out that as a dividend once we sell the property for there. If you go and have a look at the IRRs, again the IRR will be lower for this type of development because we're holding it for a longer period of time, so it's a blend of development and investment. Investment, say, has an IRR hurdle around 11%, development at 20%. So it's a combination of weighting of those two different hurdles based on the period of time held that calculates out that IRR, generally around that 14 or 15% example. Because we're borrowing money at a cheaper rate, we're leveraging this investment, and therefore that's why the equity IRR is higher, because it's been leveraged on that particular basis. So that's an overview of the financials, where we have used two methods of on completion and percentage completed, and we've also shown you the fixed asset register, which allows you to take up an investment and drag it out of work in progress and put it into the fixed asset register. So that's where this line is where we take it out of the out of the work in progress and put it in the fixed asset register. And we only use these lines once we realise. So this is the actual disposal cost. So this is the disposal line, and this is the proceeds from the sale that we do. Again, it all ties back to the cash flow, and if it doesn't, we start getting some red warning signals here. This check balance lets you know that everything is working well in that particular case. So if anyone has any particular questions, we can save this particular demonstration to the file and allow other people to watch it on our YouTube channel. Okay, so this running through, in this case, we make our inputs into the cash flow and goes into there. The financial then takes that and, depending upon the settings that you have, works out how to do the P&L. And I guess the important thing is P&L is not the cash flow. They're two different things. They relate to the tax laws. Okay, well, thank you very much for being a good audience, and look forward to you getting some more feedback on this particular demonstration, and happy modeling. Thank you. Some land holding costs, which is giving me these type of total costs. So the net cash flow before interest is a negative 2.8 million, but because we're doing a staged development, we've got some sales occurring in year 1, 2 and 3, we have some positive cash flow there. When we take into account the amount of money we put in $1 million equity, we come down here and we find we borrowed this amount, we actually find that the cash flow is a significant 2.8 million in the very first year, and then some positive returns, 1,075,000, 1,075,000, and then 2,175 at the end. Briefly, if I go to the financial section, the P&L, here's the items that we discussed before coming through, but in the P&L, we have a different story there. Some costs are expensed, and we show a loss in that particular case of a certain amount. We expense the operating expenses as well as some holding costs. We showed a negative 201, and we can go from there. So let's call back in option 1 for me. The very first thing to note is the financial sheet does not appear at the bottom here until we go up to Preferences, go into Financial Reporting and click Enable Reporting. That's the very first little thing to note. Now that financial sheet appears. Now the very first important point to make is that cash flow does not equal profit and loss. But what I mean by that is that in this particular example, I have a land purchase of $1.5 million. For simplicity, I've only used time periods of annual time periods just to demonstrate this. But essentially, I have a land purchase occurring in the first year, some professional fees which spread over over 3 years, and some construction costs which spread over 3 years, land subdivision costs. And I also have some group overheads, and I have 50. So that negative 250 in the P&L is significantly different to the negative 2.8 million. I guess this is the important point for the non-accountants listening in on this webinar, is that the concept of work in progress, it's similar to as if you bought a property, say a rental apartment, say you paid $1 million and you're going to get an income of $50,000 or $60,000 each year from it. The taxation department doesn't allow you to write off that $1 million as a tax deduction for that year. What they say, no, that is an investment, and against that investment you can claim depreciation, and you claim the interest as income against, the rental as income, and if you have some borrowings on that, you can claim the interest on that. but you don't claim the capital cost. In a similar way, when you do a property development, the taxation department says that that's a particular asset that you're building, and you have to build that, and you can't realise that expense. If you had some other colleagues who wanted to join, I do apologise. The actual original invitation had an incorrect address for this meeting, so we have updated everyone with a new address, but just in case you don't see one of your friends there, just maybe forward the email with the new address so they can join us as well. So let me begin now. I'll just run through that PowerPoint, and I'll bring across a model which I have prepared. This feasibility model is, I've got a number of different options in here. I've got option 1 for land subdivision, and we're using the revenue recognition method of on completion. And then I've done another one where we use it on a completed basis, and I'll show some variations that we have on that. And finally, I have an option where we actually develop a building, hold it as an asset for 10 years, and then sell it. So that's another project which I'll show how to do. But I'll start with the first one. Welcome everyone to the Estate Master User Group live seminars. This is Series 7 of our series for the user group, and today I'm going to provide you with an introduction to the financial sheet and the preferences. The course will outline the concept of profit and loss versus cash flow, the concept of work in progress, operating expensed costs, and revenue recognition, as well as a fixed asset register in case we want to hold the assets for, say, renting. And then the presentation is around 35 minutes, and then we can have some questions and answers. Each of the attendees have been muted just to make the sound easier for everyone to hear. But if you have any questions, please don't hesitate to use the comment box to contact me.